Welcome everyone to our presentation today on saving for college and paying for college. I'm joined today by Andrew Randisi and Christopher Mallon, both certified financial planners here at Pennsylvania Capital Management. And let's get started. We're going to start off talking about saving for college. And Andrew, you wanted to talk about 529s?
Yeah, I'd say, Lesley, thank you for having us today. I'd say there's a couple different ways you can for college. And we talked to this about quite a few of our clients. There is the 529 plan route, college savings plan. You can also do an UGMA or UTMA account, depending upon the state you're living in. There's also something that still exists, but it's a very rare species, which is the Coverdale Education Savings Account. But I would say for the most part, what we work with clients on is the first two, the 529 and the UTMA and the UGMA account. The real main advantage we really like on the 529 is the various different aspects of how you can get that tax-free growth for college. You also have the flexibility in terms for college as well, that you can use it for tuition, you can use it for books. You also can even use it to pay back up to a certain amount dollar threshold student loans. And it also can be used for private school tuition from ages kindergarten through 12th grade. Now, it can also be used for a trade school as well, with the most recent passing that we've had in the last couple of years.
Can't you also do stuff with Roths now with those? Because I know we have come across some situations where 529s can be essentially overfunded. So say they started when a kiddo was born, they're approaching college years, and there's a couple 100,000 in the account, and then they're going to finish school and have maybe $50,000 or $30,000 left over. What can you do with that now?
Yes, so with that new little quirk that just came in recently, up to $35,000 can be rolled out for the beneficiary to a Roth IRA of the beneficiary. A couple things to keep in mind, though. The 529, I believe, has to be somewhere around at least 15 years old with that beneficiary. And it can't be, there's also a specific test on the earnings. The earnings can't be rolled out that have grown in the last 5 years. But yes, if you do meet all those criteria, you can roll out lifetime $35,000 to a Roth IRA for the beneficiary of the 529. Another neat idea, we have leftover funds. We might not have any more children to roll it to, or if we don't want to roll it to grandchildren that might not be here yet, they can be rolled out to a Roth IRA for that beneficiary.
Yeah, I'd say the 529 has become really it's the backbone of college savings at this point, and then they keep adding new features and make it a little bit more flexible. A couple years back, you couldn't use it for private high school or education. Trade schools was a little bit murkier on what could and couldn't be used for. And then there was definitely none of the rolling out to a Roth or retirement account either. So now they keep, it seems like every 2 to 4 years or so, there's another feature added, which is nice, which frankly will maybe down the line make the UTMA and UGMA custodial accounts less and less of an option. Because I'd say right now, we typically recommend is a combination of both, with the 529 doing the heavy lifting for education focused spending, and then the UTMA and UGMA accounts being more of a focus on, okay, this will be money for postgraduate down payments for house, down payments for cars, maybe cover a trip in the future. That's really like your chief in the way of flexibility, because at the end of the day, that account is really a brokerage account for your child, and that will eventually become theirs once they hit 18 or 25, just depends on whatever state they're in. But however, with that level of flexibility, there's less tax incentives, right? You're going to have capital gains tax along the way, interest income taxes on those along the way. So there's no real tax incentive for that UGMA accounts. However, you do get the flexibility incentive, so you can use it for anything as long as it's for the child. Another drawback of that, I believe, and correct me if I'm wrong, Andrew, the UTMA and UGMA accounts, when you go through the FAFSA process in terms of trying to get various student loans, I believe that's counted more against you in terms of, not necessarily against you, but it is looked at more of, okay, we're going to see if student A qualifies for certain financial aid. If they have, say, instead of doing a 529, there's $100,000 in a UGMA account, that's going to be looked at more. Oh, there's a lot more money to pay for college here versus if that same 100,000 was in a 529 that was owned by the parent. I think they're looked at different percentage wise.
You are precisely correct. So for FAFSA, if mom or dad have that example that you gave, 529 plans are counted as part of the FAFSA as 5.6% of assets when they do that calculation. So if you have 100K in a 529, 5,600 would be included and would be that expected family contribution. For the UTMA account, it's 20%. So $20,000 would be considered in the mix when the FAFSA would be calculating the potential financial aid package.
Yeah,
So
there's obviously pros and
there
cons.
are some advantages to stuffing those 529s.
Yeah, one other thing to keep in mind, we've had the opposite situation happen. We've had it for some clients along the way with the UTMA and UGMA accounts. Say that was the focus. There's no 529 contributions. So there was $100,000 in that UTMA account. And then the age of majority in many states is 21. A student rolls around, they're entering their senior year, they hit 21 years old. All of a sudden, all that money is theirs. The account flips over on that day and is an individual account for them. It is not uncommon for some parents or clients of ours to come to us and go, okay, hey, we love our kid. We're not necessarily sure if they're ready to have 100 grand plus in their name. It's irrevocable. You can't undo it. There's workarounds we come up with, but it's not, you can't all of a sudden when they hit 21, 22 and say, oh, actually, that's all our money because we contribute all of it. You can't flip it back into your own name. It has to remain in the kid's name, at least in some capacity.
Yeah, and we've seen 100 grand as a drop in the bucket for an UGMA or a UTMA account. We've seen some in excess of $500,000 to pushing $1 million.
Yeah.
That's quite, I'd say, not every client at the very beginning of, oh, our little Johnny or little Susie is born, doesn't necessarily realize they're getting that account. They've made great contributions throughout the years. The way the investments have been managed, it's grown, it's done fantastic. The money is not theirs. With the 529, mom, dad, grandma, grandpa, they still retain control, even though it is for the beneficiary. Grandma and grandpa, mom and dad are in charge, not the kiddo.
Sounds like you're recommending 529. Keep the accounts small and pump all you can into the 529s. Is that fair?
I'd say that's typical. It depends on the end of the day what the goals are of the client. There's some situations where it's like, hey, we're high income here. We're going to just pay for college out of pocket. We want to set up a trust account for our kid in the future. And college is covered because we're longtime alumni of this program. We've given millions of dollars to this school, like college will be covered, or some circumstance where focusing on filling up a 529 would not be the best interest. But I'd say, yeah, typically it's education savings. The 529 is going to do the heavy lifting, and then anything into the other account will be more of a gift for postgraduate spending, maybe some odds and ends during college, but it's less of a focus on education. I wouldn't classify it as hey, we want to save for education. My first recommendation wouldn't be, hey, let's fill up an UTMA and UGMA. That would be if you're filling up the 529 enough and it's like, hey, I also want to do this separately. That's where that sits in.
Okay. Maybe this is a good segue, or do you have more you want to say on that?
Oh, no, yeah, I was about to kick it over to you to talk about the actual paying for college process, because there's a difference between the savings buckets, it's filling them up, and then you get to the actual years. Okay, now it's time to fill out the FAFSA, and then what student loans are out there, financial aid, what's that process?
Yeah. The first thing I'll say is the FAFSA form, it's the federal form for financial aid. All colleges require it for financial aid. Some colleges, mostly private colleges, will require a second form. It's the CSS. Forget what it stands for, but do you know, Andrew?
CSS profile.
Yeah. CSS profile, but I don't know what CSS stands for. Something statement.
College student something.
Student statement or something. Yeah. Anyway, CSS profile is required by a lot of the private schools, private small schools. The thing about the FAFSA, and I have people come to me all the time and say, I'm not going to bother. I'm not going to get any money, so I'm not going to bother. But the thing is, you can get the federal loans if you do the FAFSA, and anybody can get the federal loans. That you won't get the subsidized ones, you'll get the unsubsidized ones, which means that the interest accrues from the moment that you take out the loan, whereas the subsidized ones, the interest holds off until after you graduate. But I think it's a great way to just get some loans anyway. And I have friends actually who, because of financial reasons, don't actually need the loans, but they take out the loans and then they just pay off the loans when the kid graduates. It's a way of using the money in the loan program and then paying it off when the kid graduates. Or maybe they pay off half of it and have their kid pay off half of it or something. So I think it's a great way to start your kid on a financial journey too. If they've got to make even if it's $100 payment a month or something to pay off their college, I think it makes a lot of sense. So I'm
Yeah.
a big proponent of doing the FAFSA. I know it's a pain in the neck and it's paperwork and it takes a while and you have to involve your kids because they have to do a certain part of it and there's a little training thing that your kid has to go through saying that they understand that they are taking out a loan and they will have to pay it back. But I think it's all just part of an educational journey for your kids as they're emerging into adulthood. You guys have
Yeah,
any?
I think it makes it real for them. I'm thinking about my daughter's 2 now, but when it comes to the college process, definitely want her involved with it. So if you do want your kid to grow up and be able to manage finances on their own, which I think every parent would want, it would be okay, let's get them some experience going through processes like these instead of it being like, oh, parents are going to take care of it all the time. And it's, oh, I don't need to worry about that. Parents taking care of it. And then all of a sudden, then they finish college and they're getting the first job and everything. And they're going, hey, what do I do here? And maybe the parents aren't the best financial resources for things. Everybody has their own mistakes or financial issues. And then the parents go, oh, figure it out. And then the kids goes, I've never had to do any of this before. So yeah, it's good to get involved in the front end. And then I think it gets some skin in the game at the very least, or at least they're cognizant of, hey, this isn't all free. Oh, parents aren't just, this costs money. So it gets you, okay, I'm going to work hard and do a good job in school because I know this, people are making sacrifices for this to happen. And it's all good and healthy instead of it being like, oh, don't worry about it. And then one day when somebody does have to worry about it, then they would not maybe be less prepared than if they were upfront with it on the start.
Yeah, exactly. I totally agree. I had one other friend, I thought this was a clever idea too. They didn't take out any loans. They fully paid for their kids' college. But as soon as the kids got their first job, they said to them, listen, I fully paid for college for you. You're starting off your working career with a pretty good advantage having no loans. So I want you to max out your 401k. And like that was their requirement. I gave you this gift of no student loans, max out your 401k from day one. I thought that was a great idea too, just to teach them the value of what the gift was of college and how to save really well starting off.
Yeah, especially when you look at first jobs out of school with, say, 2 different kids graduate, one has $30,000 of student loans to pay back or more. And so when it has zero, just that net cash flow difference is going to be quite dramatic at the end of every month. So we're like, okay, take advantage of the fact that you have this, that you're a step ahead here instead of spending the extra money. Okay, maybe if you're saving it here, then that'll just frankly make later in life easier too, because then you can front load retirement savings a little bit. And then when you're a little bit older down the line, be like, okay, maybe we can slow down retirement savings because that's been so well funded on the front end. Yeah. Yeah.
Yeah.
It's a great plan.
Yeah. The other thing I'll mention too, and my kids just graduated from college, as Chris and Andrew know, so this is a little fresh in my mind. But both of my kids had jobs all 4 years of college. And not only was it really helpful for finances, but it was a great way for them to meet people. Because at the jobs, it was people that were maybe outside of their major or where they lived or their social scene. So I'm a big proponent of either work study if you can get it from your school or just having them have a part-time job on campus or near campus. My kids did teaching assistant. They worked at a coffee shop, ice cream shop, the dining center. There's tons of jobs on campus that kids can get. And I think it's a great way to help your kids on the financial journey.
And in order to qualify for work study, you need to fill out the FAFSA. So no matter what, start there. And then some schools too, there's the federal student loan things and everything, but a lot of times the schools themselves will look at what you fill out in the FAFSA and they might have their own parameters for different scholarships and things, being like, okay, here's what the government will subsidize or not subsidize in terms of loans, but we're going to up it to a certain higher amount for them, income limits and things like that. And then it's going to be different things, there's tuition reductions or scholarships and things that if you opted out of filling out the FAFSA, you wouldn't necessarily be able to get.
Yeah, sounds good. And then one other thing I'll just note too, most colleges have payment plans. It's a little bit cheaper if you pay the full amount at the beginning of the semester. They charge you some sort of small percent, or maybe it's a $50 semester fee, but you can pay monthly rather than having to come up with the big chunk at the beginning of the semester. The other thing, I'm not super familiar with this because I didn't have to do this, but there's private loans. And from everything I researched, the private loans are more expensive and less favorable borrowing terms. So if you do have to borrow money for college, definitely start with FAFSA because you're going to get better terms than that. Do you have anything to say about the private loans?
Yeah, for private loans, this is where the private loans I'd say can come in handy after school is done and the first job is obtained. And there's pros and cons to doing it. We did it. My wife did it for her graduate school, got private loans. I guess she might actually had private loans on the front end, and then we refinanced them to another private loan when all said and done. I wasn't involved on the front end, but on the back end, once she started earning an income, then all of a sudden you can get much better interest rates. Sometimes they're better than what the federal rates will be, because the federal ones are not necessarily looking at really like credit worthiness. It's just, hey, here's what the rates are no matter what. So depending on what that postgraduate, whatever that job is after you graduate and credit scores and everything, it's okay, might be able to get a better rate here. Then you have to look at the math. And maybe if I'm working in a nonprofit for 10 years and then some certain student loans are forgiven, that wouldn't happen if you had private loans. And then during COVID for a while there, when you didn't have to pay student loan interest back, everything was frozen. My wife was not like, we were paying along the whole way because the interest wasn't frozen. It was just, hey, here's this loan. So there's definitely advantages and disadvantages to both, I'd say, but that's a case by case basis. But yeah, on the front end, typically we wouldn't recommend getting private loans unless the parents taking them on and they're say, hey, my credit's great. I'm going to take this loan. The rate's low. I can keep this money growing in the 529s and elsewhere, and I'll pay a bunch of it off at the end. But that's not usually the first lever we'd pull. Usually the last lever, frankly, if it's needed.
Yeah. I think that's it on our list of topics. Andrew, anything additional to add?
Yeah, I think we pretty much
Covered it.
I guess the one thing you mentioned, paying directly to the institution. If grandparents, nieces, aunts, uncles, great grandparents, parents want to make an unlimited gift, that doesn't count against the annual $19,000 exclusion for college tuition. If grandma and grandpa pay, and we do a lot of the coordinate this with a lot of our clients, if they pay the tuition directly, they can pay an unlimited amount. It doesn't go against that $19,000 annual exclusion.
Good to know. So you pay the institution directly and it doesn't count.
Yeah.
Okay, great. Thank you both for this conversation on saving for college and paying for college. And as always, if you have any questions, please feel to reach out to us at pcmadvisors.com. We are on the website and you can find our contact info there. Take care, everybody.
Thanks.